5 major banks are now sitting on positions they mathematically cannot escape. 4.4 billion ounces of silver promised. But the metal has vanished from the vaults. One bank issued 35,000 claim tickets for only 100 coats in the back room. A classified UBS report just surfaced, marked urgent. Switzerland's largest bank facing existential collapse. TD Bank stopped out at $78. Silver breached $92. Multiple institutions now insolvent. The fire alarm is going off, and the people want their coats back. What happens when mathematical impossibility meets contractual obligation? Welcome to Currency Spot. If you've built something in your life, a business, a portfolio, or simply decades of hard-earned savings, when you understand the value of reliable intelligence, this isn't entertainment. This is strategic economic analysis for serious decision makers. We ask one small favor: hit that subscribe button. Consider it your ticket to the coat room. Except, unlike certain banks we'll be discussing today, we actually have the coats. And tell us in the comments, where are you watching from today? New York, London, Singapore, Mumbai? Your geographic position matters in what's unfolding. Let's proceed with the briefing. The financial world operates on trust. Banks promise to hold assets. Investors believe those promises. Contracts guarantee delivery. Everyone assumes the system works, until it doesn't. Right now, 5 major banking institutions are sitting on short positions that defy basic mathematics. They have promised to deliver 5.2 billion troy ounces of silver. They have sold contracts. They have taken premiums. They have collected fees. But there is one small problem. The silver doesn't exist. An analyst examining the commodities market recently described the situation using a simple analogy. Imagine a restaurant coat check. A customer arrives, hands over their coat, receives a ticket. Simple transaction. Trust established. Now imagine the coat check attendant issues 35,000 tickets, but only has 100 coats hanging in the back room. Everything seems fine. Until closing time. Until people want their coats back. Until 350 people show up, all holding valid tickets, all expecting their one coat. This is not a hypothetical scenario. This is the current state of the silver market. The ratio has reached critical levels. For every physical ounce of silver available for delivery, there are 350 claims against it. Every contract, every promise, every obligation. All mathematically impossible to fulfill. A classified report recently surfaced. The document came from UBS, Switzerland's largest banking institution. The classification level? Urgent. The report was not meant for public consumption. It was sent via confidential channels. The contents? An existential crisis, not just for UBS, for the entire European banking structure. Someone with access to internal banking communications received this document. They understood its implications. They shared it quietly. The message was clear: do not tell anyone. But the information was too significant to remain hidden. The report confirms what market analysts have suspected for months. UBS holds a massive short position in silver. The bank promised delivery. The bank collected payment. The bank assumed prices would fall. They assumed wrong. When an institution takes a short position, they are making a specific bet. They believe the price will decrease. They promise to deliver an asset at today's price, sometime in the future. If the price drops, they profit. If the price rises, they lose. But here is the critical factor most people miss. When shorting any asset, the downside is limited. The price can only fall to zero. Maximum loss? The current price. But the upside? Infinity. Silver could theoretically rise to $100, $200, $500 per ounce. There is no ceiling, no mathematical limit. The losses become unlimited. Right now, these 5 banks are holding positions with infinite risk exposure. They cannot buy their way out. The physical metal does not exist in sufficient quantities. They cannot close their positions without triggering a cascade. One financial expert examining this situation put it simply: you cannot buy 4.4 billion ounces of silver. It just doesn't exist. The vaults that were supposed to hold this metal? Empty. The storage facilities that guaranteed delivery? Inadequate. The promises made to investors? Impossible to keep. This is not about market volatility. This is not about temporary price fluctuations. This is about systemic insolvency masked as normal business operations. Every major bank likes to project stability. They publish quarterly reports. They show adequate reserves. They pass stress tests. They maintain credit ratings. But beneath the surface, a different reality exists. These institutions are carrying obligations they cannot fulfill. They have sold products they cannot deliver. They have made promises they cannot keep. The question is not whether this situation is sustainable. It clearly is not. The question is, what happens when the market realizes the emperor has no clothes? When investors demand delivery? When contracts come due? In traditional banking, when deposits exceed reserves, the system faces a liquidity crisis. The bank cannot pay everyone at once. They rely on the statistical probability that not everyone will withdraw simultaneously. But commodities markets operate differently. Contracts have expiration dates. Delivery is mandatory. Physical metal must change hands. And when the metal is not there, when the vault is empty, when 350 people show up for their one coat, the mathematical impossibility becomes a market reality. This is not speculation. This is not theory. This is happening right now. The classified report confirms it. The market data supports it. The institutional behavior reveals it. The fire alarm is not coming. The fire alarm is already ringing. The only question remaining, who will be left without their coat when the music stops? The first domino fell on a Tuesday morning. Traders were watching their screens. Nothing unusual. Just another day in the silver market. Prices hovering near comfortable levels. Volatility within normal ranges. Then something broke. TD Bank's position hit its stop-loss level at $78 per ounce. The automatic trigger fired. Computers began executing. Buy orders flooded the market. Not small orders, not retail orders, institutional-sized blocks that move markets. But here is what makes this different. When TD Bank needed to close their short position, they had to buy silver, real silver, physical delivery contracts. And when you need to buy that much silver that quickly in a market that already lacks supply, prices do not just rise, they explode. Within hours, silver breached $92. Then it kept climbing. The stop loss that was supposed to limit TD Bank's damage, it triggered a chain reaction that made everything worse. Other banks watched in horror. They held similar positions, similar exposure, similar assumptions that prices would stay contained. Those assumptions were now burning to ashes. Financial news outlets started picking up the story. Headlines appeared. Silver shorts burned alive. Another read, multi-million-dollar position stopped out at $78. The internet erupted with speculation. Comment sections filled with questions. Did TD really get stopped out at 92? Are they insolvent? Who else is holding similar positions? But the answer to that last question, everyone. Not just TD Bank, not just UBS. The entire institutional banking sector had been playing the same game, shorting silver, collecting premiums, assuming endless supply at contained prices. But markets have a way of exposing false assumptions. And when exposure happens at the institutional level, the consequences spread far beyond trading desks. A recent survey revealed something troubling. 92% of employed Americans have been forced to cut back on spending. Not unemployed Americans. Employed Americans. People with jobs. People with paychecks. They are working, but falling behind. Their standard of living is crumbling. Expenses rising faster than income. Savings depleting faster than accumulation. The gap between earnings and survival costs widening every month. This is not coincidence. This is not temporary. This is the same systemic problem showing up in different forms. When major banks face insolvency from silver shorts, and when working Americans cannot afford basic expenses, the root cause is identical. The purchasing power of their money is evaporating. Most people do not understand the difference between assets and liabilities. A high school teacher once conducted a simple experiment. He asked his students to name one asset. Any asset. Real estate, stocks, precious metals, anything that holds or increases value over time. The students could not answer. Not a single student could name one asset. Then he asked them to name a liability, something that loses value, something that drains wealth. The answers came immediately. Cars, phones, clothes, electronics. This is the fundamental problem. Society has been trained to accumulate liabilities while avoiding assets. The financial system encourages this behavior. Buy the new phone. Upgrade every year. Finance the depreciating car. Use credit for consumption. Meanwhile, the wealthy operate by different rules entirely. They accumulate assets, stocks, gold, silver, copper, platinum, real estate, tangible items that preserve purchasing power across time. Then they use something most people fear, debt, but not consumer debt, not credit card debt, not debt for depreciating liabilities. They use strategic debt, debt at 3% interest, debt at 4% interest, debt backed by appreciating assets. This is how the tax system works. This is what experienced investors understand. This is the strategy employed by every major wealth builder in modern history. They borrow against their assets at low interest rates. They never trigger taxable events. They never sell their appreciating holdings. The debt is cheap. The assets grow faster than the interest cost. Meanwhile, the government continues deficit spending. The world drowns in household debt. But there is a critical distinction most people miss. Good debt versus bad debt. If someone borrows money to buy a depreciating car, bad debt, their net worth decreases. If someone borrows money against their portfolio of income-producing assets, good debt, their net worth increases. The banking sector understood this principle. They used leverage extensively. They borrowed to amplify returns. They used derivatives to multiply exposure. But they made one catastrophic error. They leveraged against an assumption. They assumed silver would stay cheap. They assumed supply would remain abundant. They assumed they could always cover their positions. Now the market is teaching them a lesson that every trader learns eventually. Assumptions are not facts. Leverage amplifies everything. And when you are wrong with leverage, you do not just lose money, you lose everything. The money market funds are watching. The institutional investors are repositioning. The smart money has already moved. They are exiting equities. They are accumulating hard assets. They are preparing for what comes next. Because when major banks start failing on silver deliveries, the problem does not stay contained in the commodities market. It spreads everywhere. There's a photograph that tells the entire story. In the photograph, someone holds a single silver coin in their palm. One coin, 1 troy ounce. The caption beneath it reads, "This is $1 of silver." The photograph was taken in the 1920s. At that time, $1 could purchase 1 ounce of silver. The exchange was direct. The value was stable. The purchasing power was real. Today, that same ounce of silver requires $102. Most people look at that number and think, silver went up. They are wrong. Silver did not go up. The dollar went down. The purchasing power collapsed. The currency devalued by 99.5% over 1 century. This is not inflation. This is systematic wealth destruction. An economist studying historical price movements recently made a striking observation. He compared the cost of a family vacation to Las Vegas. In the 1920s, such a vacation might cost $50. Today, that same vacation costs over $8,000. The vacation did not change. The hotel rooms are similar. The entertainment is comparable. The distance traveled is identical. But the currency required to purchase that experience increased by 164%. Now here is the critical insight most people miss. During that same period, silver also increased by 164%. The numbers match perfectly, not by coincidence, not by accident, by mathematical certainty. When currency loses purchasing power, assets that hold real value reflect that loss. Silver is not becoming more valuable. Silver is maintaining its value while the dollar disintegrates around it. This is the bullwhip effect in monetary systems. The devaluation begins at the source. The government prints more currency. The new money enters circulation slowly. Eventually, the impact reaches every corner of the economy. Prices rise, wages stagnate, savings evaporate. The working population feels poor despite working harder because they are poorer. Their dollars buy less, their labor exchanges for diminishing value, their stored wealth melts away. But there was a specific moment when this acceleration began. A date when the trajectory changed permanently. December 1971. Before this date, the United States operated under a different monetary system. Citizens could exchange their paper dollars for physical gold or silver. The government maintained reserves. The currency was backed by tangible assets. Then President Nixon made an announcement. He stood before cameras and declared that the gold standard was no longer necessary. The American people would trust their government. The paper currency would hold value through faith alone. No more gold redemption. No more silver backing. No more walking into a bank with paper notes and demanding physical metal. The transition was sold as progress, as modernization, as a necessary evolution of the monetary system. What actually happened was the largest wealth transfer in human history. In 1971, silver traded at $1.30 per ounce. Today, it trades above $90. That represents a 6,900% increase in the number of dollars required to purchase the same physical metal. The silver did not change. The metal is identical. 1 ounce in 1971 weighs exactly the same as 1 ounce today. But the currency? Unrecognizable. A financial historian examining this period described it as Tricky Dick's greatest trick. The population accepted paper promises instead of physical value. They trusted the system. They believed the government would protect their purchasing power. 53 years later, the results are undeniable. The coat check scenario is not just about silver delivery, it is about the entire monetary system. The government issued trillions of dollars in promises. They printed currency without backing. They created obligations without assets. Now the fire alarm is sounding. People are showing up at the coat check. They're holding their tickets. They want their coats. They want their silver. They want the value they were promised. And the vault is empty. Recent market data shows something unprecedented. Posts across financial platforms declare a full-blown currency collapse. Analysts debate whether the term is accurate. Some argue the collapse already happened decades ago. Others insist it is happening right now. Both perspectives contain truth. The currency has been collapsing slowly for 50 years, a steady erosion of 99.5%, but slow collapses eventually reach acceleration points, moments when the gradual becomes sudden, when the theoretical becomes real. The last time silver experienced this type of price movement, the broader stock market dropped 58%. Not a correction, not a healthy pullback, a full systemic unwinding. Market analysts examining current technical indicators see troubling parallels, major indices showing topping patterns, distribution signals appearing, Smart money quietly exiting positions. The setup looks familiar. The conditions match historical precedents. The timeline suggests proximity to major transition. One trader studying these patterns described the situation simply: "We have been waiting for this short squeeze for years. This is not speculation anymore. This is execution." He held up a silver coin during his analysis. The metal gleamed under studio lights. Clean, tangible, real. Unlike the promises in bank vaults, unlike the digital numbers on screens, unlike the paper contracts that cannot be fulfilled. Silver exists. The coins are real. The metal has weight and substance. But the dollars required to purchase that metal? Those numbers keep climbing. Not because silver is becoming rare, because dollars are becoming worthless. This is the uncomfortable truth that most people refuse to accept. Now, their savings are not safe in banks. Their retirement accounts are not protected by government guarantees. Their wealth is denominated in a currency that loses value every single day. The banksters made promises they cannot keep. They issued tickets they cannot honor. They sold products that do not exist. And now, after 53 years of gradually accelerating devaluation, the people want their coats back, all of them, at once. The mathematical impossibility of the silver market is not separate from currency collapse. It is the same problem, different symptoms, identical disease. The question is not whether the system survives. The question is, who will still be holding real assets when it finally breaks? The professional traders saw it coming. While the general public debated whether silver would rise or fall, the technical analysts were already positioned. They had studied the charts. They had identified the patterns. They had calculated the probabilities. And they were ready. One experienced trader sat at his desk on a Tuesday morning. Multiple monitors displayed different markets: NASDAQ, Bitcoin, silver futures, gold. Each chart told a different story, but the underlying message was identical. Major trend reversals were approaching. He focused on the NASDAQ first. The index had been climbing for months. Retail investors celebrated new highs. Financial media praised the bull market. Everyone felt confident. But the chart showed something different. The price had reached a critical resistance level. It touched the upper boundary, then it closed below a key moving average. The indicator turned purple. This was not a minor signal. This was a structural breakdown. The trader drew a trend line across his screen. He marked the support level below. Then he calculated the distance. If the pattern completed, the move would generate thousands of dollars per contract. But that was just the beginning. Below the initial support level, another pattern was forming, a rising wedge. This formation appears when prices make higher highs and higher lows, but the upward momentum weakens. The angle narrows. The buyers lose conviction. Rising wedges are bearish. When they break hard. The trader marked 3 price targets on his chart. First target, immediate support. Second target, deeper retracement. Third target, major correction zone. His indicators confirmed the analysis. Everything aligned. The technical setup was clean. He switched to the silver chart. This market told a completely different story. Where NASDAQ showed exhaustion, silver showed explosive potential. The price had been compressed for years. Institutional short positions had kept it contained, but compression eventually leads to expansion. The trader zoomed into a 2-minute time frame. This is where execution happens. This is where profits are captured. He watched the white price line move across his screen. It approached a critical level. His phone buzzed. An alert notification. Eyes on. Prepare for movement. This alert system was custom built. It tracked specific technical conditions. When multiple indicators aligned, when institutional volume appeared, when momentum shifted, the system notified him immediately. The price broke above resistance. It accelerated. The trader entered a position. 2 contracts. Entry price marked clearly on his screen. Silver moved fast, not the slow grind of long-term investing, the violent swings of leveraged futures. Within minutes, the position showed profit. $600, then $625. He exited at his target. Total profit, $1,225. Time elapsed less than 1 hour. This is not gambling. This is technical precision. This is pattern recognition combined with disciplined execution. The same 2% move on a single NASDAQ contract, $25,000. A full round trip capturing both directions, $50,000. 2 contracts, $100,000. The mathematics of leverage are simple. The trader does not need $100,000 in his account to control $100,000 of market exposure. Futures contracts provide leverage. Capital efficiency multiplies returns, but leverage cuts both ways. The same force that amplifies profits also amplifies losses. This is why most retail traders fail. They see the profit potential. They ignore the risk management requirements. The professional trader understood this completely. His account balance, $231,000. His daily return target, 1%. 1% sounds small, conservative, almost disappointing, until the mathematics compound. 1% daily does not equal 365% annually. The actual number is far higher. Each day's gain becomes part of the next day's base. The account grows exponentially, not linearly, but this requires consistency. It requires discipline. It requires treating trading as a business, not entertainment. The trader had multiple income streams. Self-directed trading. Automated systems running algorithmic strategies. Long-term holdings in physical assets. Real estate generating rental income. He described his approach simply, I have multiple vehicles. Some I drive manually, some are self-driving. All of them go out and make money while I focus on the next opportunity. This is the difference between amateur and professional. Amateurs chase single opportunities. Professionals build systems. Right now, while silver executes its historic short squeeze, while banks scramble to cover impossible positions, the professional is also watching Bitcoin. The cryptocurrency had dropped from its peak. Retail investors panicked. Social media filled with negativity. The typical emotional cycle that accompanies every major market. But the trader saw something different on his chart, a bull flag pattern. This formation appears during strong uptrends. The price consolidates, it pulls back slightly, it forms a rectangular channel, then it breaks higher and continues the original trend. Bitcoin was forming this pattern right now. The structure was clean, the probability was favorable. However, there was also a competing possibility. The trader drew another pattern on his chart, left shoulder, head, right shoulder. The classic head and shoulders formation that signals trend reversal, which pattern would complete, which probability would play out. He did not need to guess. He simply waited for confirmation, let the market show its hand, then execute accordingly. His accumulation zone was marked clearly, $60,000 per Bitcoin. Strong historical support, multiple tests, high volume area indicating institutional interest. If Bitcoin dropped to that level, he would deploy $10 million. With leverage, that becomes $100 million in market exposure. But only at the right price, only with proper risk management, only when technical conditions align. This is counter-cyclical investing. When everyone else panics and sells, the professional buys. When everyone else celebrates and buys, the professional takes profit. Real estate showed the same opportunity. Throughout 2026, the general public avoided property markets. Too expensive, too risky, wrong timing. The professional saw opportunity. Buy low, sell high. The oldest strategy in existence, the one that still works. He applied this across every market: copper, silver, gold, stocks, homes, land. When assets are cheap and despised, he accumulates. When assets are expensive and celebrated, he distributes. The current silver situation represented the culmination of years of patient positioning. The banks had shorted. The professionals had accumulated physical metal. Now the mathematical impossibility was becoming market reality. The trader leaned back in his chair. His screens displayed multiple profitable positions. His systems continued executing. His long-term holdings appreciated. He had one message for those still watching from the sidelines. Stop complaining about the system. Learn how the system works. Acquire the skills necessary to profit regardless of conditions. The future belongs to those who prepare. 2026 flows into 2027. Knowledge transfers across generations. Skills compound like interest. The coat check is still issuing tickets. The vault remains empty. The fire alarm continues ringing. But some people are not waiting in line hoping for their coat. They are already wearing it.